Right now, an invisible race is happening for control over the world's money. Not over interest rates, not over politics, but over infrastructure, the code, standards, and networks that decide how value moves. 3 projects are quietly building the pipes for that future: Quant, Ripple, and Chainlink. Each promises to connect today's disconnected world of banks, blockchains, and digital currencies, and whichever one succeeds first could shape how every single transaction on Earth flows. So in this deep dive, we'll unpack what these projects are, how they work, and why the battle for interoperability might decide the future of money itself. Welcome back to the channel. I'm Paula, and this is where we break down crypto, economic, and the shifting power behind digital money. If you're new here, hit subscribe and join the Wolfpack, because today we're going way beyond the headlines into the architecture of the next financial era. Let's start in London, where a small British company has spent the past 7 years quietly building what could become the universal connector of finance. It's called Quant Network Limited, founded by Gilbert Verdian, a security expert who once worked on security frameworks for the UK government and the International Organisation of Standardisation, better known as ISO. Verdian was directly involved in the development of ISO 20022, the new global language for payments. That experience shaped everything about Quant's design. From day one, Quant wasn't about competing with Bitcoin or Ethereum, it was about connecting them. The company's flagship technology is called Overledger, an operating system for blockchains. Instead of creating another chain, Overledger sits above existing ones and lets them talk to each other, and even to legacy banking systems that still run on decades-old infrastructure. Think of Overledger as a universal translator. If one network speaks Ethereum and another speaks Ripple or Hyperledger, Overledger converts the data and moves value seamlessly between them. For enterprises, that's huge. Banks, governments, and corporates don't want to rebuild their systems from scratch. They want a safe plug-in that makes the new world of blockchain compatible with their old technology. Quant's design makes that possible. Access to the network runs on the QNT token. It's an ERC20 token on Ethereum, with a fixed supply of around 14.6 million, roughly 12 million in circulation. To use Overledger, companies and developers lock QNT to pay for licensing and transaction fees. It's not mined, it's not inflationary, it behaves like a scarce software license key. That structure means that if Overledger adoption rises, token demand should rise naturally with it. Unlike many tokens created for speculation, QNT's role is deeply functional. It gates access to Quant's ecosystem. Quant launched in 2018, right before the crypto market crashed. Most ICO-era projects vanished. Quant survived by keeping its focus narrow, enterprise-grade interoperability. While others chased retail hype, Quant worked on compliance. Verdian built connections with government agencies, financial institutions, and standard bodies. By 2020, Quant had already collaborated on pilot projects with major consulting firms and regulators. That slow, steady approach positioned it perfectly for what came next: the global push towards tokenized deposits and CBDCs. In 2023, Quant joined the UK tokenised sterling deposits project, exploring how banks could issue digital versions of pounds that comply with existing regulation. Quant's Overledger was selected because it's ISO 20022 native, meaning it speaks the same language that central banks are now adopting for payment messaging. This wasn't a crypto experiment in a lab, it was a live proof of concept run with established financial institutions. The result? Quant positioned itself not as a rebel outside the system, but as a bridge into it. The world is moving towards a tokenized economy. Money, stocks, bonds, even carbon credits will exist on digital ledgers, but right now those ledgers don't connect. Ethereum can't talk to Hyperledger, Ripple can't easily connect to Bank's private chain. That's the bottleneck Quant aims to solve. If successful, Quant could quietly become the middleware of global finance, sitting invisibly between every digital asset and bank. And here's the clever part. Because it's built around ISO 20022, banks don't need to change their messaging or compliance frameworks. They just plug in. It's the same strategy the internet took in the 90s. Build a common layer so everyone can connect without replacing their hardware. Overledger could become the TCP IP of money. So what's its strengths? Enterprise-first design and regulation readiness, limited token supply and real utility, active involvement in the UK and EU tokenization pilots. But the weaknesses? slow adoption cycles in the banking sector, low retail visibility, heavy reliance on institutional partnerships. Quant is built for the long game. Its biggest challenge isn't technology, it's time. Convincing conservative institutions to adopt new rails could take years, but once they do, switching always becomes almost impossible. That's the network effect Quant is betting on. So that's Quant the connector, a company that's been trying to overhaul cross-border payments for more than a decade. Ripple. Ripple's story began in 2012, the early wild days of crypto when everyone was still arguing over what Bitcoin even was. While most projects were obsessed with decentralization for its own risk, Ripple asked a different question. What if we used blockchain to fix the global payment system itself? At that time, international transfers moved through SWIFT, a messaging network built in the 1970s. Transactions could take days, cost up to 10% in fees, and require multiple correspondent banks along the way. Ripple's founders, Chris Larsen and Jed McCaleb, built the XRP Ledger, a fast, efficient blockchain designed purely for payments. The goal was simple but radical. Move money anywhere in seconds for fractions of a cent. The XRP token would act as a bridge currency, a neutral asset that could convert any fiat into any other instantly. So if a bank in Japan wanted to send money to Brazil, it could go yen, XRP, reals, all settled in under 4 seconds. Over the next decade, Ripple built RippleNet, an enterprise-grade payment network. Banks like Santander, SBI Remit, and Tranglo in Asia joined early. RippleNet let institutions exchange messages and value directly, cutting out multiple middlemen. By 2019, Ripple software was handling billions in payment volume, but then came the biggest challenge in its history. In December 2020, the US Securities and Exchange Commission sued Ripple Labs and its executives, alleging XRP sales constituted an unregistered securities offering. The case shook the entire industry. Exchanges delisted XRP, price plummeted, and critics predicted the end. Yet Ripple did something rare. It fought back publicly. For 3 years, the case dragged on, becoming a symbol of the regulatory grey area around crypto in America. Then in 2023, a federal judge ruled that XRP is not a security when traded on exchanges. It was a partial victory, a turning point that restored institutional confidence and gave Ripple the momentum to pivot into its next phase. With its legal battle largely behind it, Ripple refocused on central bank digital currencies. It launched a CBDC platform on the XRP Ledger and began partnering with countries like Bhutan, Palau, and Montenegro to pilot national digital currencies. This is Ripple's long-term vision, a world where every central bank has its own tokenized currency and Ripple's network connects them all. In that future, XRP could become the liquidity layer for instant global settlement, the digital bridge asset between all fiat. The strengths? Real-world adoption by banks and payment providers. Fast, low-cost transactions already proven in production. Legal clarity after the SEC decision. Position in CBDC and remittance markets. But the weaknesses? Banks can use RippleNet without holding XRP. Reputation damage from regulatory scrutiny. Competition from new instant payment systems like FedNow and SEPA Instant. Ripple is the oldest of the 3 projects in our story and the closest to mainstream finance. But it isn't alone in chasing interoperability. Next comes a project that quietly became the data backbone of crypto itself, Chainlink. Every blockchain is a closed system. It can verify its own data, but it can't see the outside world. That creates a problem for smart contracts. How can a contract trigger a payment based on a stock price or a weather event if it can't access that information? That's where Chainlink comes in. Founded in 2017 by Sergey Nazarov and Steve Ellis, Chainlink built a network of oracles, data feeds that bridge real-world information into blockchains. A DeFi protocol needs the current ETH USDT price to calculate collateral. It gets that data from Chainlink. If an insurance contract needs weather data to trigger a payout, it comes from Chainlink. Over time, this made Chainlink the default source of truth for decentralized finance. Chainlink runs on the Link token, an ERC20 asset used to pay node operators for providing accurate data. Users pay in Link to request feeds, and operators stake Link to prove their honesty. It's a self-reinforcing economy of trust. Link is not a governance token or utility for transactions. It represents data integrity. For years, Chainlink was known as the Oracle provider for DeFi, but in 2023, it launched its most ambitious project yet, CCIP. the cross-chain interoperability protocol. CCIP allows different blockchains to send messages and value to one another through a secure, verified pathway. It's essentially a standardized communication layer for blockchains. The same problem Quant is tackling, but from a different angle. Where Quant integrates traditional finance, Chainlink focuses on cross-chain crypto ecosystems. Its strength lies in its existing infrastructure, hundreds of partners, thousands of data feeds, and a reputation for reliability. Even Swift, the global bank messaging network, ran tests with Chainlink to see how traditional finance could interact with tokenized assets using CCIP. That's a huge signal of where things are heading. Blockchain tech moving from retail speculation to institutional infrastructure. So its strengths? Massive integration base across DeFi and enterprise projects, proven reliability of Oracle feeds, strong partnerships with Swift, Google Cloud, and major financial players, a bridge that already handles billions in data calls daily. But the weaknesses? Complex token economics and unclear value captures for holders, still focused on crypto-native use cases rather than mainstream banking. Intense competition from new data protocols and cross-chain bridges. Chainlink's strategy is simple. Own the trust layer of the blockchain economy. If you control the data, you control the logic of money. All three projects we've looked at, Quant, Ripple, and Chainlink, are building towards a massive inflection point in finance, the global adoption of ISO 20022. Let's unpack what that means and why it matters. ISO 20022 is an international standard for financial messaging. Basically, the syntax that banks use to communicate payments and transaction details. For decades, most banks used older formats like Swift MT messages, short text codes that couldn't carry much data. ISO 20022 replaces that with a richer XML-based standard capable of including metadata, purpose codes, and structured references. In plain English, it lets money and data travel together. Between 2023 and 2025, major payment systems, Swift, Target2 in Europe, CHAPS in the UK, and the Federal Reserve's Fedwire in the US are all migrating to ISO 20022. By 2026, the majority of cross-border transactions will use this standard. That creates a new environment where digital assets, CBDCs, and legacy bank payments can share a common language. Quant was built for that future from the start. Ripple is re-architecting its messaging to be compatible with it, and Chainlink is designing CCIP to feed data into systems that will rely on ISO 20022 metadata. Once banks, blockchains, and payment providers speak the same language, the old barriers fall away. A CBDC issued on a private ledger could interact with a stablecoin on Ethereum or a bond on a regulated tokenization platform. That's true interoperability, and it's exactly what these projects are chasing. The transition to ISO 20022 is the bridge between legacy finance and digital money. It's the reason this race exists at all. Now that we've explored each project individually, let's stack them side by side. Quant connects networks, Ripple moves value, Chainlink verifies truth. Together they're racing towards one goal, a unified financial system where digital assets, banks, and data all flow through shared rails. Each sits on a different layer of the same stack, but the boundaries are starting to blur. Quant's strength lies in regulation and compatibility. Its ISO 20022 native runs on enterprise-grade APIs and doesn't require banks to rip out all their infrastructure. That makes it the most plug-and-play solution for traditional finance. Its limitation, adoption speed. Banks move slowly, and until they fully commit to tokenization, Overledger will remain mostly behind the scenes. Ripple already has the largest institutional network in production. It's proven, regulated, and now focusing on CBDC pilots. But its centralized governance means some crypto users see it as blockchain without decentralization. And if banks use RippleNet without XRP, token demand could remain capped. Chainlink already powers much of decentralized finance. Its oracles secure billions of dollars in smart contracts, and CCIP could make it the default bridge for tokenized assets. The challenge? Value capture. If link usage doesn't translate into holding incentives, the network might thrive even if the token lags. So here's the truth. Each of these projects solves a different piece of what people call the interoperability trilemma. How to connect data, value, and compliance without breaking trust. Ripple solves the value side, Chainlink solves the data side, Quant solves the compliance and connectivity side. Whoever balances all three first could become the backbone of global finance. Let's zoom out. Between 2025 and 2027, the financial landscape is shifting faster than most people realise. Centralised bank digital currencies, CBDCs. Over 130 countries are exploring them. China already pilots the digital yuan. The European Central Bank plans digital euro tests through 2026. The UK is researching a digital pound. These systems need secure, interoperable rails, the exact speciality of Quant and Ripple. Major banks like JP Morgan, HSBC and Santander are tokenizing cash and bonds for instant settlement. Overledger and CCIP could link those private ledgers to public chains. By 2026, virtually all cross-border payments will use ISO 20022. That standard creates a universal data format that Quant already speaks natively. Investment firms and banks are experimenting with permissioned DeFi, regulated smart contracts for loans and liquidity. Chainlink's data feeds are crucial here. The lines between crypto and traditional finance are vanishing. We're entering what some call the Internet of Value, a network where money, data and identity flow like information does today. So what's the likely scenarios? Scenario 1. Convergence. Each project finds its niche and coexists. Ripple handles payment, Quant handles infrastructure, Chainlink handles data. They interconnect through standards like ISO 20022 and CCIP. Scenario 2. Institutional dominance. Banks adopt closed systems and use crypto tech internally, limiting token utility. Quant and Ripple thrive as companies, but their tokens become background infrastructure. Scenario 3. Open network victory. Public blockchains win regulatory trust. Each path still ends with interoperability because without connection, none of it works. What fascinates me most is that beneath all of this technology lies a question about trust. Ripple says, trust us to move your money faster. Chainlink says, trust the data, not a company. Quant says, trust the bridge that connects everyone safely. In the end, it's not just a race to build software, it's a race to define how trust works in the digital age. I often think about how this mirrors the early internet. In the 1990s, we had thousands of networks that couldn't communicate. Then a few protocols, TCP, IP, HTTP, changed everything. No one owns those protocols, but entire industries were built on top of them. That's where we are today with blockchain. Quant, Ripple and Chainlink are building the financial TCP, IP of the future. But there's another side to this, control. If these bridges connect everything, who controls the gateways? Governments? Corporations? The code itself? The answer will decide whether interoperability creates freedom or a new form of centralization. So who wins the race? Quant the connector, Ripple the mover, or Chainlink the oracle of truth? Maybe none win alone. Maybe they'll merge into the invisible infrastructure we'll all use without even realizing it. What we can say for sure is this: the old financial system is being rewired right now. The code is already running, and it's just a matter of which protocol becomes the default. Have you heard of these projects before? Which one do you think will shape the future? Quant, Ripple, Chainlink, or something we haven't seen yet? Drop your thoughts below. I read every comment. If you found this deep dive valuable, hit like, subscribe and share it with someone who still thinks crypto is just about prices. And join us in the Wolfpack. We look past the charts to see how technology is quietly rewiring power itself. I'm Paula, and you've just seen how 3 projects are racing to connect the world's money. Thank you for watching, and I'll see you on the next one.